when you think about pools of capital, you can categorize them by three main kind of drivers. And those drivers tend to be kind of what is the dependence of the organization on the pool of capital for kind of operating needs? What is the nature of the liabilities? Are they more variable or are they more fixed? And what is the investment horizon? Is it finite or is it infinite? Our effort is to concentrate in markets where we think there's a lot of inefficiency and a lot of innovation. We think those markets are more fertile for alpha over time. We think the risks you take in venture are technology risk, market adoption risk, and execution risk. That's a lot of risk to take to drive return. So, our expectation in the venture asset class is that we want funds that produce more than 5 times multiple over an 8 to 10 year period.
Hey everyone, this is Prashant and I'll be your host of the VC10X podcast, and today we have Muthu Muthiah with us. Muthu is the CIO at Children's Healthcare of Atlanta, or CHOA in short, one of the largest pediatric care providers in the United States of America. At CHOA, Muthiah leads the investment office, which manages the system's long-term $6.4 billion of investment portfolio. Previously, Muthu has been in several allocator roles at different types of institutional pools of capital. In this episode, we talk about difference in how endowments, pension funds, foundations approach asset management. What are the key levers in asset management at institutions? How does the investment team look like at an institutional fund? What are the different types of people that work there? The different asset classes that CHOA is invested in and the percentage allocation to each of those. How do endowments look at venture capital asset class? The S-curve of investing, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Muthu, so good to have you on the VC10X podcast. How are you doing?
Hey Prashant, I'm doing great. Thank you for having me.
Yeah, pleasure having you on, and been wanting to have you on for so long, and finally we get to do this, so I'm really happy. To start things off, can we first have your story, a little bit about your background?
Yeah, absolutely. So I've been, I guess, now in the allocator seat for over 20 years. Time's kind of flown by, but I'm originally from India. I did my undergrad in India, in Manipal, and then moved to the States for grad school, and then kind of ended up staying here. And over the last 24 years, I've been in the allocator seat. I've had kind of the privilege of working across various different types of pools of capital. So, I started my career at a small boutique investment bank, which is a very, very short stint, and then moved on to work for the Florida State Pension Fund. And then I worked for a couple of endowments, University of Richmond and Emory, and then worked for an outsourced CIO for a while, so I had a taste of that, and then a foundation, and then now I work for a hospital system. So it's been a lot of fun kind of working across, honestly, different types of pools of capital.
Absolutely. Yeah, that's quite interesting. And to have you on the podcast, you have the perspective of how different kind of these asset pools look at investing in general, right? So can you give us a view into that, how, let's say, endowments, pension funds or foundations approach their asset management and how they are different from one another?
Yeah, absolutely. I think the main kind of driver of your approach to investing or your investment philosophy really is the nature of the capital, and what objectives kind of fall out, and trying to marry those two things up. So when you think about pools of capital, it feels to us generally that you can categorize them by three main kind of drivers. And those drivers tend to be kind of what is the dependence of the organization on the pool of capital for kind of operating needs? What is the nature of the liabilities? Are they more variable or are they more fixed? And what is the investment horizon? Is it finite or is it infinite? Finite or infinite, yeah. And you can generally put organizations into categories based on those three things. And if you think about endowments and foundations, and you think about kind of the nature of the capital in terms of dependency ratio, it generally tends to be a little lower. In terms of the liability, it generally tends to be variable. And in terms of the investment horizon, it tends to be infinite. So if you have those three kind of categories or drivers as a nature of capital, it allows you to do two main things, which is take more volatility through equity exposure and take more illiquidity, which kind of is the basis of the endowment model, right? It's equity bias and illiquidity. And then on the other side of that spectrum, if your organization has a high dependence on the pool of capital, if the liabilities are more fixed in nature, and the investment horizon is a series of finite kind of investment horizons, then you have to take a different approach, which is more of a liability driven approach. And that's kind of how pension funds and folks in that spectrum approach things. But as you can imagine, Prashant, we think that's a spectrum of things, and it's hard to kind of put people in big groups. And but along that spectrum, I think people fall in different places given the nature of their capitals. Like even among endowments, your dependency ratio can be pretty high in certain instances. So you might have to kind of veer more towards a different approach. But I think those three things are, in my opinion, what kind of generally drives the asset allocation philosophy.
Right. Yeah, that's very, very interesting to learn. And how is that reflected in the kind of asset classes that these different pools of capital are more interested in?
Yeah, I think I think the asset class interest comes from the specific organization. I think it's harder to kind of pin that in broad categories. I think the allocations, the specific allocations to certain asset classes, I think varies given the drivers of the pool of capital. So I think it really does boil down to how much liquidity can you take, how much kind of equity exposure can you take as the big kind of drivers, right? And within equity, I think people, have their own biases towards whether they think, long short equity or long bias equity is something that is functionally good for the portfolio, or, venture versus buyout is good for their portfolio. But I think the broad swath of, assets is available to most, if not all, organizations and institutional investors. I think it's more about how do you size each one of those, within the framework of your liabilities and your dependency and your investment horizon.
That's quite interesting. And you've played the role at a lot of these places as a decision maker. And even right now at CHOA, you're doing that, right? So, how does your role as the CIO become important in deciding where should I put what kind of allocations and in which asset classes should I be more interested in and things of that sort?
Yeah, so I think, as we look at the world, it really, to us, boils down to kind of, four things that we do, right? It's asset allocation, it's investment selection, it's portfolio construction, and it's risk management. And the fifth one is stakeholder management, which is the team and governance and all the structures that come with that. So, another way of saying that is, our basic focus is figuring out where do we invest, what do we invest in, how much do we size it, how do we think about risk top down, and how do we keep all the stakeholders engaged and looking at the same direction and pursuing the same objective. So where I tend to spend my time as CIO is kind of on asset allocation, risk management, and portfolio construction. And the team, we have a deep, broad team of highly experienced people that work in each asset class as generalists, and they kind of take the lead on manager selection, which I'm involved in and participate in. But I spend most of my time kind of on asset allocation, portfolio construction, and risk management, and then stakeholder engagement. And the other way we kind of look about it or think about it, or I think about my role, Prashant, is it feels like when you look at investing you can draw it in kind of concentric circles, right? So, the biggest circle is the opportunity set of what you have to invest in, which is broad and it's basically everything, right? But there's another circle that constrains your opportunity set, which is your skill set. Like you should only invest in things that you know and know how to analyze. So that opportunity set, I think, gets smaller because of your skill set. And then sometimes it can get even smaller because of the constraints that you place on the portfolio. And I feel like my job is to think about the constraints and only have the most appropriate constraints that meet our risk and objectives. So my job really is to keep trying to expand, I think, the constraints. And the team's job is to keep kind of expanding their skill set. And if we can do those two things together, we can cover more of the opportunity set. So that's kind of how I think about it too, is like part of my job is to think about whether we have the right constraints on the portfolio, and if those constraints actually help us meet the objective.
Right, absolutely. And what are the key levers that you can pull as a CIO in asset management? So, for example, let's say there's liquidity is one factor that you have to take into consideration. Then there's sustainability. Then there's growth. Right? How do you keep a balance of all these things and maybe some other aspects that I didn't mention?
Yeah, and absolutely. So I think, we think about the levers for our performance against our benchmark. So, our benchmark is on the public equity, on the equity side of the portfolio, our benchmark is MSCI ACWI, and on the fixed income like side of the portfolio, our benchmark is the AG. So we think about that and say, look, if we're to outperform that benchmark, the levers for us translate into things or big buckets of risk that aren't in the benchmarks. So if you think about MSCI ACWI is, it's diversified, it's liquid, it doesn't have any leverage, and it's investable across all periods of time, right? So the big buckets of risk that we have to take to kind of outperform that are the exact opposite, which is concentration, illiquidity, leverage, and timing, right? So those are the four levers that we have to pull on the equity side of the portfolio. And for us, those levers translate into tools that we use to pull those levers. So in terms of concentration, our effort is to concentrate in markets where we think there's a lot of inefficiency and a lot of innovation. And the reason for that is we think those markets are more fertile for alpha over time. And so we want to concentrate more in those types of markets. We take illiquidity through our private equity and venture portfolio, and leverage and timing is our hedge fund book. So it kind of, when you look at the benchmark and you look at the buckets that aren't in the benchmark, it kind of translates to those four levers, and those four levers for us translate into, the tools or the asset classes and the managers that we use to kind of, drive that return going forward.
Yeah, absolutely. And give us an insight into how do global events or even policy changes or maybe changes in the interest rate environment, how does that reflect or affect how do you do asset allocation at the
Yeah,
institution?
I think, the interest rate obviously drives everything. And I think for us, what interest rates drive is the allocation between kind of credit or fixed income like investments and equity like investments. And obviously the risk rate that we're willing to take for illiquidity, et cetera. So I think that dynamic kind of, pushes how much we have in equity like and how much we have in, fixed income like in the portfolio. Outside of that, Prashant, we are not macro investors. So we do not invest based on macro. We are very much fundamental investors. And the way we think about it fundamentally is, do these markets offer the opportunity for our managers to run concentrated portfolios of high quality companies? And then what, if anything, does the macro kind of affect that outcome, right? At the end of the day. So when we look at, political events or risk events, on the global scale, we kind of think about, can our managers still navigate through that? So as we marry it up, we kind of say, hey, we're looking for inefficiency, we're looking for innovation. And the third tail is that we're looking for a healthy market. And, a healthy market for us is defined as, is there a risk or a probability that we might have a zero capital event, that we could have, a total loss in the portfolio, not just volatility, but a a complete drawdown. And so we keep that in our view, to say, like, can this event lead to a capital loss event within our portfolio, what we hold. And outside of that, we honestly let our managers navigate through that. And we also have a preference for managers that stay out of kind of the realm of regulation and the realm that could have more of an effect on the fundamentals, on their specific portfolios too. So it's very much a focus on, we want to be in these broad markets. We want to make sure that, we don't lose our capital in these markets, but we also want to get leeway to our managers to be able to navigate those markets. So one thing that we do focus on, Prashant, is kind of aperture, right? So, for example, in China, if somebody had a very big aperture on what they're willing to look at in China, it probably wouldn't be a fit for us. But, folks that we are invested with, we think have a smaller aperture and they go after, smaller opportunities that still kind of might persist, no matter what the macro situation is. So that's kind of generally how we approach macro.
Yeah, that's quite interesting. And I'm not sure if that's something that you look at when you're making these allocations in different geographies, specifically, right? So let's say the rupee is declining in terms of the dollar, right? Does that affect the investments that you're making in India, or you're looking to make an investment in India? How would that affect your decision? Yeah.
Yeah, so we would in the India specific case, in that instance, to try to align ourselves with the growth of the underlying businesses or the assets outstrips the currency devaluation. So, we have a focus on venture because we think, venture type returns in India allow you to do that, that you can kind of outrun the currency devaluation. And then our public equity managers also think through that in terms of what growth rates are they expecting to make up for the currency devaluation over time. So we try to focus on, I think, on the India case specifically, on asset classes and managers and specific investments that we think can offer us a rate of growth that can outstrip the currency devaluation, which again is not a large aperture, right? So I think
Right.
at the end of the day, like our aperture is pretty small on the things that we do in the geographies that we do them, but we're not afraid of concentration. So when we find things that work for us, we're very happy to get concentrated in it.
Absolutely. And when you're looking at returns that can also outpace the currency devaluations, what are those kind of ballpark multiple that you're looking for? Let's talk about the VC asset class. In that,
Yeah.
What are the kind of multiples you're looking at there?
Yeah, so I think we think about kind of asset allocation and expected returns across a kind of spectrum of revenue that we kind of think about it on an S curve. So if you plot revenue against time, and it's kind of an S curve, and that the way we think about it is the first part of that S curve where you're going from losses or zero revenue to some kind of revenue, that's venture, and we think that asset class the returns are driven by innovation. So we want to be in markets that have a lot of innovation. But we think the risks you take in venture are technology risk, market adoption risk, and execution risk. And so that's a lot of risk to take to drive return. So, our expectation in the venture asset class is that we want funds that produce more than 5 times multiple over an 8 to 10 year period. And we don't think that's broadly available. So again, we try to focus very specifically on people that we think, can produce those types of returns. But in the venture space, that's kind of our expectation. And then when you move across that S curve, the next kind of quadrant we think is growth, where revenues are going from something to something else, maybe, with high growth. And we think what drives that return is scaling. And we think what risk you take in that bucket are execution risk and market adoption risk for the most part. And for that, we expect kind of 3 to 5 times at a fund level over like a, I'd say 8-year period. And then the next quadrant is buyout, where I think, revenues are more mature. Companies have been around longer. And there we think the returns are really driven by efficiency gains. And so the risk you take is 100% execution. And so for that, we expect kind of between 2 to 3 times multiple over like a 6 to 8 year period. And then the final part of that quadrant, we think, or at least you could plot it as public markets, right? And we think what drives return in public markets is having differentiated perception. And we think differentiated perception exists in inefficient markets. And we think, or at least we expect in that portfolio to generate returns of kind of beta plus 1 or 2%.
Right. Yeah, quite interesting. And you mentioned about the S curve, and can you briefly share what are the different stages of that S curve?
Yeah, I think the ones that I kind of described. So venture, growth, buyout, and then, public markets. And so,
Right.
when you plot them against that, I think you could kind of plot what are the drivers in each one of those. And the drivers, I think in venture is innovation. I think the driver in growth is scaling. I think the driver in buyout is efficiency. And the driver in public markets, we think, is differentiated perception. And then we kind of think about what risks do we have to take to drive those returns. And if you go through those quadrants again, I think in ventures, those three: tech, market, execution, the risks keep getting smaller, right? Really, and in growth, it's execution, and it's market adoption, and then it's just execution. And then, obviously in the public markets, it's execution too, but it's not in your control really, right? The management teams control it. And then you have the expected return for each one of those kind of asset classes, as you think through what your objectives are. But I think what's more important is that it gives you a framework to compare across asset classes. Because, at the end of the day, it's all equity exposure. So, the way we think about it is, we don't have asset class buckets. We have two very broad asset class buckets. So, we think the asset classes on the equity side they're structures, right? At the end of the day, they're kind of making you ask the question or answer the question of how to own something. And if you don't think in asset classes, you're more apt to think about what you want to own. So since we don't have the asset classes, we can think across that S curve as to where the best opportunity is, and then think about structure on top of that. And, I'll give you an example. So even in the India case, right? One way you could think about it is like you're really attacking growth, right? Let's say you are thinking about how to allocate your growth dollar. You could allocate your growth dollar to kind of, scaling high growth companies, in Western developed markets, right? And there, I think what you're fundamentally saying is that because most sectors are so saturated, you have to kind of take market share from a competitor, right? And at some point, you're changing consumer behavior, I think, right? Which is not an easy thing to do. I think in terms of, generating returns, it's not impossible, but it's not easy. But then you think about places like India where, growth is really driven by growth of wallet, right? So, as consumers' wallets are growing, they're just consuming more. And those investments are available in the public market. So since we don't have specific allocations to those two buckets, we can think across both of them and say, is my dollar more worthwhile being allocated to a public Indian growth company, or is it more worthwhile being allocated to a private developed world growth company? And so we can make those decisions, and we don't go one way or the other, but we kind of do both, and we compare things relatively on that basis too.
Yeah, absolutely. Thanks for sharing that. And talking about your internal teams at institutional funds, give us an insight into that. How big are those teams, and what are all the different departments there? What kind of people work there, and things of that sort?
Yeah, absolutely. I think, the size of teams is generally driven by the size of the AUM. So, for us, we have a 16-person team right now. And I think, the two models that people generally gravitate towards are a generalist model or a siloed model. And in the generalist model, you kind of have folks working on everything across all asset classes. And then in the siloed model, as you're aware, you have asset class folks that work on specific asset classes. And, from my experience, what I've noticed is that most siloed models look and feel the same, because the asset classes generally look and feel the same. And I feel like every generalist model is very unique to the organization itself, right? So, the way our generalist model works is that, we have a, 16-person team, and we tend to work together as groups of 3 on each investment that we're looking at, and on each investment that is already in the portfolio. And it tends to be people that have different biases. So, on a private equity fund, you'll have 3 people that are either, in charge of the relationship or the monitoring or the underwriting, and they'll generally come from different backgrounds. So one will have a hedge fund background, one will have a public equity background, one will have a private equity background. So we think that it helps to kind of have these conversations with folks with different biases on the same kind of investment opportunity, so that we can make better relative value decisions, is the way we approach it. But I think, the general model looks very different, in different places. The way we try to make it work for us, because it can be a little bit more kind of organized chaos, perhaps, right? Because people are knocking into each other. And I think the way we think about it, work on it, is, the basis, I think, to get the generalist culture right is to have a great culture. And so we work a lot on culture. We work a lot on, having tough conversations with each other, and driving conversation forward. And I think creating a safe place where people can disagree with each other, and all of those things, right? And also kind of keeping the portfolio as the objective and not just a single asset class. So I think the first thing for us, at least, is to just build a great foundation of culture that can support that. And the second is to have clear frameworks on what we're looking for in each thing that we want to do, so that when people are sourcing, they're sourcing within those frameworks, right? So, I'll give you an example. Like we have a framework for most of the asset classes that we look at in terms of what is the first level screen, right? So if you think about the buyout portfolio, we think buyout is really 3 things. It's buy, build, sell. So we want to look for managers that buy in inefficient markets, which we think is small cap markets, defined for us as like companies with EBITDA below 10 million. And we want them to, build, right? So we want them to find companies that have enough inefficiencies where they can add efficiency. And that tends to be in the small market too. And then we want them to be able to sell in most market environments. And we think the small market buyouts can do that because they sit below mid-market, large market, and a lot of liquidity on top of them. So the team debates a lot about what we're going to look for in each asset class. So in the buyout world, we kind of came to that conclusion that that's what we want to look for. And that hangs as the framework on top of the sourcing funnel, so that when people are out there sourcing, no matter what asset class they're sourcing in, there's some common understanding of kind of what we're looking for. And so we like to say that everybody's responsible for the top of the funnel. And then as a team, we're responsible for the bottom of the funnel. So every week we talk about, the investments that are in the pipeline, the people we're talking to, the people who've been sourcing, and kind of work them through kind of into the portfolio. So what we really like to do, Prashant, is to create tension between the pipeline and the portfolio, while remaining kind of long-term investors with our partners. I went off on a little bit of a tangent there, but coming back to kind of team structure, generalists generally, or siloed generally, the type of people that end up working at an allocator, I think, has changed over the time that I've been kind of doing this. I think nowadays I see folks that kind of, grew up in the allocating world, more so than prior. And then you still have, I think, people that come in from direct investing too. So even in our team, we have a mix of folks that kind of have always been on the allocator side, and other folks that have been kind of direct investors at the GP, or in a specific asset class. And we think that gives a good mix too of folks that kind of grew up thinking about allocating, and folks that grew up thinking about, specific investments in that asset class. So that's how we structured it. But I tend to find folks from kind of both of those backgrounds, I think, in most organizations.
Absolutely.
Did I answer everything? Oh, and I guess the big,
Yeah,
for us, the other kind of, because we don't have the asset classes, people aren't organized in asset classes, but, the distinction I guess we have is that we have an operating team that focuses on, operations of the department. And then, we have an investment team that focuses more on the investment aspect of of what we do, but we generally, we're one team, so we try not to make that distinction.
Yeah, that's a very interesting approach on all fronts on how things work at CHOA, right? So thanks for sharing that. And would you be open to sharing what is the ballpark percentage allocation to different asset classes? And
Yeah,
yeah,
no, absolutely. I'm happy to do that. So, we have a 70-30 split, 70% towards equity-like investments and 30% to fixed income-like investments. And the way we really think about that, Prashant, is like anything with an equity beta above zero point 0.5 competes for capital within the equity-like book. So the things that compete for capital are kind of long only, long biased, long short, venture, buyout, generally in that portfolio. And then on the fixed income portfolio, fixed income like portfolio, everything with an equity beta below 0.5 competes for capital. So generally that's fixed for us. It's fixed income, cash, credit hedge funds, and diversifying hedge funds, and with a skew more towards the diversifying hedge funds and credit. So if you thought about kind of our allocation across, those broad buckets, right now we do have about 70% in equity in general. We have 27% in private market investments, venture and buyout together, which we're continuing to kind of scale up over time. We have a very small long short equity portfolio. I think right now it's probably about 10% of the book or so. And there's a reason for that, perhaps. Like we think long short equity works in places where you have fertile shorting markets. And, we define fertile shorting markets of having kind of clear catalysts and clear dispersion in performance. And we don't think those places are very broad. We think, again, those places exist where you have inefficiency. So, and innovation, because it can be fairly binary. So within a long short portfolio, I think most, if not all, of our long short managers are focused on biotech because we think science is a clear catalyst and we think there's clear dispersion in returns there. So that's kind of where we are in long short equity, long biased equity. And then on the more defensive side right now, I think, we have about 10% in diversifying hedge funds, about kind of 10% credit hedge funds, and the rest is, cash fixed income, that sort of investment.
yeah. Thanks for sharing that. That's very informative. And
Yeah.
talking about the investment cycles, right? So, what are the investment cycles that you follow? How often do you deploy, and in what time frame are you looking for returns? And if you can give that answer for all the different types of institutional LPs out there, that would be great.
Yeah, I think it's for I can answer for us. I mean, and I think for most long-term investors, I could venture to say, but I think it's again unique to each institution. But for us, we look at it on a 10-year rolling basis. So we're really thinking about generating or meeting our return objective over a 10-year rolling basis. And the way we come to that in terms of specific asset classes, I think at the end of the day, we own a portfolio of catalysts. So, our public equity managers are investing in companies where they think certain catalysts will evolve to add value over time. And our private market, managers are investing in companies and driving those catalysts themselves to an outcome. So when we think about the book in catalysts and what the duration of those catalysts are in terms of what we can expect for returns over a certain time horizon, we think the public equity portfolio is a collection of 3 to 5 year catalysts. So over a 3 to 5 year period, what our managers own in public equity, should have the catalyst that drive that return, over that time period. So 3 to 5 usually on the public equity or public side of the book. And then on the private side of the book, if you think about venture and buyout, it takes a lot of time to drive those catalysts. These are fundamental changes to companies. These are, company building activities, which takes longer. So we think those catalysts take kind of, 5 to 8 years to emerge. So that kind of folds into our 10-year rolling period. So, we do expect returns on our public book between 3 to 5 years, and in our private book between 5 to 8, and then on the total portfolio, I'd say 10-year rolling is what we look at.
Yeah, that's quite interesting. And talking about the venture capital asset class in specific, how do you think about that asset class? And what are the key things that you look for in managers when you're looking to deploy capital?
Yeah. So, we think about the world in terms of inefficiency and innovation, right? And I feel like a broken record now saying this over and over again. But if you look for an asset class that is maybe the most inefficient and the most innovative, it's venture. So that's the reason we love venture capital, because there's a lot of inefficiency and there's a lot of innovation, which we think over time kind of drives returns. The other framework we like to think about is manager edge, Prashant, and I think we generally believe that managers have 5 edges, right? It's behavioral, it's analytical, it's relationship, it's information, it's execution. And, in more inefficient markets, all of those are available to managers. So we love venture because of that too, because, your behavioral edge, your analytical edge, your relationship edge, most importantly, the information edge you get by being a private investor, and the execution edge you get by helping your founders kind of execute on their plans, we think can add tremendous value. So for both of those reasons, we like venture a lot. And what when we think about venture, and we think about buyout, and we think about privates in general, we don't think about a target. We fundamentally believe that these asset classes are mostly alpha driven asset classes, and if you can't find the right people to execute on those, you're much better served not locking up your capital and being in the public market. So we express that in the portfolio by putting a cap on the amount of private market exposure that we can have, but not a target. So we don't have a target to private markets, but we do have a cap on private markets, and it's really driven by the fact that we don't want to take too much unfunded liabilities. So, every time we sign up for a fund, we have uncalled capital, and that uncalled capital for us is leverage because it's contractual and it's callable. So we want to be careful about how much leverage we take on the portfolio. So we limit the amount of kind of venture and buyout and privates to 40% of the portfolio, keeping in mind that we don't want more than 20% unfunded commitments as a percentage of AUM.
Right, that's quite interesting. And where does venture capital sit in the risk profile in your other asset allocation? So do you also account that, okay, I'm allocating to venture capital, but this can also potentially go into negative? There is a chance for that. So do
Yeah,
you
we
account
do.
for that?
So the
Yeah.
way we think about the portfolio construction, Prashant, is to keep kind of equity beta as our North Star, to control overall portfolio risk. So the way that works mechanically and practically is, our benchmark MSCI Acqui, 70% MSCI Acqui, 30% Ag, gives us a beta target of 0.7 equity beta across the portfolio, and that becomes our Northern Star to construct the portfolio. So we have different beta assumptions for different asset classes. For publicly traded liquid asset classes, we just measure the real beta of the managers that we're in, or the actual beta of the managers that we're in. And then in private equity and venture, we assume a beta. And our beta assumption for venture is 1.4. So what that does is we can't have too much in venture, because if we have 70% of our portfolio in venture, then our beta target is going to be above 1 for the portfolio. So it naturally restricts the amount of venture we can have in the book, because we assume a higher beta than is actual, right? Because realized returns look very different. There's volatility dampening that happens because of the valuation periods and all of those things. So we try to adjust for that to say, hey, let's look at the real risk of venture. We think it's about a 1.4 beta. So there's only so much in the portfolio that we can do, because if we do too much of something at a 1.4 beta, it's going to blow past our 0.7 equity beta target.
Yeah, that's quite interesting. And so you're not doing any direct investing in the businesses, right?
We don't, Prashant, but we do co-investing, and we do quite a bit of co-investing. So we love working with our managers on co-investments. For us, co-investing is a way to get exposure without unfunded liabilities, which is what we really like. I think the fee structures can be more interesting in most cases, but for us, it's more about not taking on the unfunded liability and getting direct exposure. So we don't do direct investing where we source a direct investment, underwrite it ourselves, but we do co-invest alongside our managers.
Got it. Quite interesting. And when you're backing VC managers, there's like two ways you can do it. One is like you go and back a GP who's managing a VC fund, and there's another way where you can go and back a fund of funds manager, and they select the VCs for you. Probably they have better access to VC managers than you do. How does that look like for you? How do you make that decision which to allocate to and not?
Yeah, I would actually disagree that fund of funds have better access than endowments and foundations. And the reason I disagree is that I think foundations and endowments specifically offer a mission that is meaningful to some folks, right? I think if you care about who your investors are and what the returns ultimately benefit, I think there's a lot of venture capital folks that prefer to be aligned with mission aligned investors where they're conscious of the fact that, hey, if I make a 10 times return, that goes to, medical research in children. So I actually think that endowments and foundations have an advantage in access, also because they have infinite time horizons and their capital is not based on fundraising. And so I think those elements, in my opinion, make endowments and foundations more preferred investors than maybe a fund of funds. But having been said, I think you're right. I think there's a lot of fund of funds out there that have amazing access. The way we approach it is to kind of, when we're sourcing and when we're talking to venture capital managers, to also give them information on our mission, and, what the portfolio has enabled in terms of our organization and the health of children. And I think that has been, somewhat meaningful, I think, to venture capital managers where capacity is constrained, but they're thinking about who's the next person that I can allow. So for us, we take a direct approach, and, kind of source directly and, talk to why we might be, value add partners. We also have, in my opinion, just an incredible operating team at the hospital system. And so we're also at certain times able to offer kind of, access to them for, specific companies that are building in healthcare, that want, either diligence notes from practitioners or even the ability to present or demo a product for consumption by the folks that operate the hospital. So I think, we try to talk a little bit about that and hopefully position ourselves as a value add investor too.
Absolutely, yeah, that's great. And when GPs are reaching out to LPs, a lot of them think that if you're a new fund manager, you should not be targeting institutional LPs and probably go to family offices and other or fund of funds, smaller LPs, and not go to institutional quality investors. Do you think that is right, the right approach, or are you as an institutional investor open to even first-time managers?
We're very much open to first time managers. So the way we think about our portfolio construction, Pranav, is like at all times we want exposure to mature managers that we consider folks that have been around for like 10 years, let's say, and plus mature managers. And then managers that we call developing, which are between 5 to 10 years of existence. And then emerging managers, which are 0 to 5. So we consciously try to construct the portfolio across all three of those things. So we look proactively for first time emerging managers, predominantly in the venture space and in the buyout space. And so we're very, very open to emerging managers. And, I think part of that is that we think emerging managers, fund sizes are more apt for them to stay in efficient markets. And what ends up happening in our experience a lot of the times is, when people mature and they have a lot of assets under management, they tend to migrate away from small, inefficient markets. So the ability for us to stay focused on small, inefficient markets has to come from funding emerging and developing managers, which we do very, very actively. My advice for GPs would be not to waste your time, on folks, to have an understanding, in some way if that institution does look at kind of emerging managers before engaging with them. Again, I think it's a bit of a spectrum, but we do know a lot of peers that we know and respect that also focus a lot on developing and emerging managers.
Yeah, absolutely. And how do you think about the stage a VC firm is focused on? Because even in startups, even in VC firms, there's different stage focus. There's
Yeah.
super early stage, pre-seed, then there is seed stage, then there is somewhat growth stage. So, what type of VC firm does sit right in the type of risk and return profile that you're targeting?
Yeah, so right now we have a preference, I think, for seed and early, and on the growth end of the spectrum, very, very specific. And I say that because we think early and seed, valuations are generally better than other places in the market. And then within growth or late stage venture, what we really focus on is folks that have um, a differentiated approach to portfolio construction. So, we like to align ourselves with people on the growth and the late stage venture side that also are willing to take a lot of concentration, Prashant, which we don't see a lot of. So, in our growth and late stage venture portfolio, we have a few managers, but they're all very much willing to concentrate their portfolios in a way that other people aren't and keep driving kind of power law economics, even though the fund sizes are a little larger. And then in the seed and early, that's kind of where most of our focus is and most of our exposure is.
Great. Thanks for sharing that. And what do you think has been your biggest learning sitting in the allocator seat for so long? And what would be your parting advice to fund managers of all sorts?
Yeah, I think the advice one I haven't really thought about a lot, but I think the biggest learning for me has been kind of as an allocator. I think sometimes you can get sucked into like big investment themes, and I think it's careful. You have to be careful. At least I've learned the lesson of being careful about the specific investments you choose. And so there's an element of like top-down thinking and an element of bottom-up thinking, and I think no matter what the top-down thinking is, it feels like the bottom-up wins at the end of the day, right? And so I think the biggest lesson that I've learned in my investing career as an allocator is like, themes can be interesting and great, but if you can't find specific investments in those themes, then you should stay away kind of from the themes in general, right? And I think it's all kind of bottoms up fundamental stuff for the most part. And I think advice for GPs, I'd say, I think the one tension that always exists or consistently exists, I think, between GPs and LPs is fund size, Prashant. So, my advice would be to kind of stay in the fund size that generated the returns that made you successful, and not grow over time because you are going to kind of get LPs that might want to kind of switch their focus or allocation on something that's a little bit more younger or emerging, let's say. So my advice would be kind of stick to the fund size in the market that's kind of really given you success. And I think at the end of the day, we like to say internally that fund size is strategy. And so the less you shift your fund size, the less you shift your strategy, and the more ability I think you have of retaining LPs for the long term.
Absolutely. Yeah. Great advice there. Now, going for the rapid fire round, wherein I'll ask you five quick questions about the LP allocations you're making into VC funds, and you have to give five quick answers, right?
Okay.
So, the first one is, what are the sectors and regions you invest in?
Yeah, so again, like we think about inefficiency and innovation, so we narrowed those two vectors we think into four things right now. India geographically for us is interesting. The U.S. is incredibly interesting given what's going on the innovation side, and then sectorally technology and life sciences. So those are the places that we proactively focus to kind of get to get invested. But we look at all asset classes, but our bias right now is towards kind of India, U.S., tech, and life sciences.
Awesome. What's the typical fund stage you're interested in? I think we covered that in the conversation, but you can mention that again.
Yeah, I think all stages. But in terms of inbound interest, we love seeing spinouts and emerging managers. We have an active list of managers and potential managers that we track over time. Prashant, and generally they tend to be emerging managers or developed managers because they exist. The thing that we don't see a lot of is the spinouts. So we would love for people to reach out if they're thinking about spinning out and forming their own thing.
Absolutely. Awesome. And what's the typical commitment size for you?
Yeah, so the way we think about it is expected return and risk. So on the venture side, we generally tend to write kind of 50 basis point checks across 3 funds. And then on the buyout side, on the other end of the spectrum in privates, we tend to write 1% checks per fund. And we generally try to underwrite relationships to 3 funds. We don't want to be in the business of just investing in one fund. So, when we are making our first investment, we try to have some clarity with our GPs on kind of what we would like to see or kind of what our expectations are to stay invested over 3 funds. And then we try to stay invested over 3 funds if those things don't change, if the philosophy stays the change, if the process stays the same, if the people, are still there. And on the public equity side, we generally tend to size our relationships between 3 to 5% of the portfolio.
Where can fund managers get in touch in case there's a direct way?
Yeah, so you can always kind of reach out to any of the team members via LinkedIn. I think we're all pretty active on LinkedIn. So there's 16 of us. If you kind of search for Children's Healthcare Atlanta, we show up. So LinkedIn is a great place to get in touch with us for ideas and manage relationships.
Awesome. Where can our listeners follow you? I guess it'll be LinkedIn again. Yeah.
Yeah, LinkedIn and then here.
Oh yeah, for sure. Awesome. Great. I'll make sure to put all those links in the show notes below that you just mentioned. And thanks so much
Yeah.
for making time for this, Muthu. It was long due, but I was very looking forward to this. And thank you for making time. And I wish you happy investing.
As was I, Prashant. This has been a great conversation. I really enjoyed it. Thank you.
Thank you so much.